This is the Retirement Lifestyle Advocates radio program. I am your host, Dennis Tubbergen. Glad you decided to tune in today. Hey, if you've not yet gotten your complimentary copy of my Retirement Roadmap book, I'd like to invite you to get one. The book is titled Retirement Roadmap, and the subtitle of the book is How Many Aspiring Retirees Can Use the Revenue Sourcing Process to Achieve a Secure Tax-Free Retirement in Today's Economy. The book was a #1 bestseller when it was released earlier this year. For those of you that supported the book, again, thank you. But if you're planning for retirement, I would like to offer you a complimentary copy of this book. Go to roadmaptoretirementbook.com, roadmaptoretirementbook.com, and request your free copy. It will give you a perspective and strategies to consider in today's economy to help you succeed in your planning. So again, roadmaptoretirementbook.com to get your complimentary copy of the book. Now, in this segment, I want to talk about a couple things. I want to talk about the economy and employment. I want to talk about how the Fed policy has also created a wealth gap, and that wealth gap is getting wider. This is really an important thing to understand as you're planning for retirement. So let me start with the economy. It's my observation, and I am not a trained economist. I believe that may give me an advantage in my opinion. But on a real basis, adjusted for inflation, it is now evident to me that we're in a recession. Now, we won't know if that's the case officially for a bit, but presently the Bureau of Economic Analysis suggests that the economy is growing at a very anemic 1%. Now, economist John Williams, who's been a past guest here on the program, who actually has the website shadowstats.com, and there's a lot of terrific information on the website. I would encourage you to check it out. Mr. Williams tracks economic data using calculation methodologies that are no longer used. Should come as no surprise that over the years, as maybe economic data is not as favorable, that the methodologies used to calculate this data are changed so that the reported data becomes more favorable. Well, Mr. Williams, going back and using methodologies that were used in the past to track economic growth, says we are now experiencing negative economic growth, which is the definition of a recession. Now, we have this strange thing going on, this strange phenomenon. Despite the weakening economy, Americans are now quitting their jobs at a record rate. 4.3 million Americans quit their jobs in August. Now, all this is sourced if you go take a look at the Portfolio Watch newsletter from last week, and you can get that newsletter for free by visiting retirementlifestyleadvocates.com, and I would encourage you to check that out as well. But this 4.3 million Americans who quit their jobs in August is a record high, and it's a record high by a long shot. Now, what I'm about to say is not a mistake. From April to August, 20 million Americans quit their jobs. Now, why is that? 20 million Americans quit their jobs from April to August. Well, there's a story on Yahoo News that says that 4.3 million Americans quit their jobs in August, but many, according to the article, bolted to take advantage of 10.4 million job openings, often at higher pay. Well, certainly some of these quits, if there's a little more than 10 million job openings and 20 million Americans have left their jobs voluntarily, you can attribute perhaps half of these quits to people moving from one job to another, perhaps to work remotely, perhaps because the working environment is more favorable, maybe because they're just making more money. But that doesn't explain the other 10 million. So we have to ask, what is the rest of the story? Well, in my view, part of the explanation lies with the enhanced unemployment benefits that were awarded very liberally. From April to August, during the time frame that we're discussing, many workers could collect about $1,000 a week for sitting at home on the couch. No, I'm not saying this is the motivating factor behind all these quits, but certainly it contributed to the record number of quits. Given a choice between collecting enhanced unemployment benefits of about $1,000 a week or going to work and making $1,000 a week or perhaps less, many workers, understandably, made the latter choice. Now, Chris Markowski commented on this. Chris is the host of a podcast titled The Watchdog on Wall Street. And this is what he said, quote, "Nobody wants to work. It's everywhere. No one has any workers. The government basically started universal basic income when they sent child care tax credits to individuals." Now, there's one other factor that Mr. Markowski points out. He said we're already in an unprecedented labor market, and now we've got a vaccine mandate on private employers, which will add to the worker shortage. Now, this is obviously the elephant in the room. And regardless as to how you feel about the mandate, regardless as to what your own vaccination status is, here's the fact. There are many workers who aren't going to get the vaccine under any circumstances, and they'll quit their jobs rather than get the vaccine. So that is another drag on employment. Now, these labor factors, regardless, again, as to how you feel about them or where you come down on it, the reality is they're just not going to help the economy recover quickly. And I think it validates my view that we are now in a recession. And I think at some future point in the not too distant future, we're going to find that that is the case. Now, let's go back to these enhanced unemployment benefits. Let's go back to these child care tax credits. Let's go back to all this money that has been distributed by the government. Well, how has this been funded? Well, it's no secret that the Fed has been creating currency at a record pace. In fact, it's obvious when you look at the wealth gap that the higher earners, the highest earners, the wealthiest Americans have benefited most from Fed policy. There was an article on Business Insider this past week that said the top 10% of Americans now own 89% of stocks. It's never been that high. The top 10% own 89%. We might as well say almost 9 out of 10 shares of stock. According to the Federal Reserve's own data, the top 1% hold 54% of corporate equities, meaning corporate stocks, and mutual fund shares. That's really all you need to know, because that alone, that statistic alone, tells you that the wealthiest Americans' fortunes have grown a lot faster than the net worth of any other segment of the population. In fact, the lowest earning Americans have actually seen their wealth decline. Certainly adjusted for inflation, that is the case. Now, if we set Wall Street aside for a second, the top 1% of Americans now hold more overall wealth than all the American middle class. There was an article on Zero Hedge this past week, and there was a chart published that was telling. The wealth of the top 1% now exceeds the middle 60%. Well, what does that mean? Well, the top 1% in income earners now have more wealth than those in the 20% to 80% percentile. That's very solidly the middle class. The top 1% now has more wealth than the middle 60% of wage earners. In fact, American billionaires over the past year and a half have added $2.1 trillion to their cumulative net worth. That's big. That statistic comes from the Policy Studies and Americans for Tax Fairness. The U.S. created 100 new billionaires over the past year and a half, going from 614 in March of 2020 to 745 in October. And the bottom 90% of Americans saw their stock holdings drop to 11% of all stocks. The bottom 50%, about 0.5%. The poverty rate, according to the Census Bureau, ticked up 1% from 2019 to 2020, and median household income also shrank by 2.9%. Again, that's according to the Bureau of Economic Analysis. So we have this, what I believe is going to be a perfect economic storm. We have the wealth gap widening, we have real incomes declining, and as I'll talk about with my guest today, Simon Popple, the inflation genie is out of the bottle. It's my belief that if you use traditional retirement planning strategies to try to achieve your retirement goals, you may fail. That's why I'm offering an additional resource to all of our listeners. It's the Retirement Roadmap book. If you're just joining me, you can go to the website roadmaptoretirementbook.com and request your copy of the book. Again, the website is roadmaptoretirementbook.com. Just let us know where to send your copy of the book. We'll send you a copy of the best-selling book, as well as some bonus information. Again, roadmaptoretirementbook.com is that website. I will return after these words with my special guest, Mr. Simon Popple. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me once again on today's program is returning guest, Mr. Simon Popple. If you are a longtime listener to RLA Radio, you probably recall that Simon is the publisher of the Brookville Capital Intelligence Report. His website is brookvillecapital.com, and his work and his publication is devoted to helping people invest in commodities. And given the world in which we live, I thought having Simon back on the program would be especially timely. So, Simon, welcome back to the program.
Thanks. Great to be here.
So, Simon, maybe before we get into, actually investing in commodities, we should take a step back and just take a look at the world at this point. And certainly here in the United States, inflation is more than noticeable. And you're joining us today from the UK, and I've been reading some stories there about energy costs and fuel costs. Seems like the inflation genie is out of the bottle.
Yeah, I know. I think that's very true. And normally when the inflation genie pops out of the bottle, interest rates are increased and, the genie is put back in the bottle. I think what the big kind of question mark is at the moment is because debt has increased so dramatically over the past few years, to what extent can they increase interest rates? Because obviously, if you increase interest rates, your debt becomes more expensive. And, on the one hand, yes, you bring down inflation, but on the other hand, you've got to then find the money to cover the escalating debt cost.
Simon, it just seems to me that, the central banks all around the world, I obviously follow the Fed being here in the States, but it seems that they're in a no-win situation. We're either going to have massive inflation, perhaps even hyperinflation. Some would argue we're on that path. Or we have, debt defaults and a severe deflationary environment that, will rival or maybe even exceed the 1930s. So what's the path forward here for central banks? And is there a way to avoid one of those two outcomes, in your opinion?
I don't think there is really. I think that they're in a horrible position. I think that the most palatable for them is probably inflation, because if you have inflation, then you can bring down the debt because you're paying people back with dollars that are worth less than what you borrowed in the first place. But that's not a long-term strategy, because the next time people lend money, rather than it's a bit like if you lend someone enough money to buy 10 bottles of wine, but they pay you back with enough money that you can only buy 5 bottles of wine. And the next time you lend them money, you're going to make sure that you've got an interest rate that means that you should get at least 5 bottles of wine. 10 bottles of wine. And I think that inflation, can work the first time round, but I think they're going to have to think of a way of making sure that this doesn't happen again. And I think the only way they can do that is to cut expenditure, and that is going to hurt people a lot.
So Simon, it just seems to me that that's very logical. That you can't have hyperinflation because we now have really the lower income earners all in many countries around the world are now trying to figure out if they pay rent or they buy fuel or they buy food, and when that choice becomes reality, you get the populace that becomes quite upset. There's a lot of social unrest, and I think we're seeing that now. Do you really think that the politicians around the world have the discipline or the fortitude to be able to cut back spending before we have a hyperinflationary outcome?
Look, they've got a lot of power. Whether or not that is used in the best interest of the greater population is another question. Unfortunately, we just don't know. But they certainly have power. But I think the big question really is how they use that power, and I think that they will be able to an extent. And I have to be careful what I say here. To an extent, that they may be able to control certain prices, but you can't control all prices. We're living in a capitalist society, so prices are met by supply and demand. But the trouble is you have knock-on effects. So for example, high fuel costs or high energy costs. They get fed into industry, and that industry then has to increase the prices of the product that they produce to reflect the higher fuel costs, and that then increases the cost of their products to, let's say, a manufacturer, and the whole thing snowballs. And it can snowball quite quickly, and even in the UK, we've overcome the fuel crisis that we have. But I mean, if that was to rear its head again, the knock-on effects of that were terrible, because it meant that people didn't have enough fuel to get to work. Now, over the short term, you can deal with that, but if that becomes a longer-term problem, then it's very, very difficult for governments to actually deal with that.
Well, if you're just joining us, we're chatting today with Mr. Simon Popple. He is the publisher of the Brookville Capital Intelligence Report. You can learn more about his work at brookvillecapital.com. So, Simon, is it your view that we are in recession or heading that way? How would you come down on that question?
It's difficult to look at a sort of exciting growth path. Headline, it could look quite good because you've got inflation. So, sales revenue is bound to go up because of inflation. So, I think initially it could look like a very nice recovery from the pandemic and from the world we live in at the moment. But as inflation rears its ugly head, then people's purchasing power will go down. So, the higher revenue, perhaps the higher earnings and things like that of the past, could feel pretty good for a short term, but when your dollar can't buy as much as it used to tomorrow as it does today, then people would demand more dollars, and that's when everything sort of starts to unravel.
Well, Simon, there's been a lot of attention, again, recently, as we're recording this. It's the 21st. This will air just a couple days after we record it. there's been a lot of renewed interest in cryptocurrencies. I think Bitcoin recently made all-time highs, and a number of investors are looking toward cryptocurrencies as a way to hedge against this inflation. Where do you come down on the cryptocurrency argument?
If I'm honest, I don't really understand cryptos. I mean, I think they've obviously got a role to play at the moment, but ultimately I think that governments will want to control currencies, and therefore I think a dollar crypto, euro crypto, yuan crypto is inevitable, because central banks want to control the money supply. And people have said, oh well, they're cryptos are different. You can't trace them and everything like that. But recently, governments have proven that they're actually quite easy to trace, and obviously, they're digital, and so I think the technology is amazing, but the extent to which they remain independent, I really don't know. And I think it was Paulson said that cryptos are a limited supply of nothing, and I'm not saying he's right, but I mean it's a very it's such a new area that a lot of people are scratching their heads and sort of wondering what's going to happen. But I think that if cryptos do start to hurt the US dollar and other currencies managed by central banks, I don't think central banks will have a huge amount of patience with them.
Well, Simon, for our listeners maybe that are not familiar with your work, and you can learn more about Simon's work at BrookvilleCapital.com, talk a bit about the Brookville Capital Intelligence Report and what it is you do. And in the next segment, our listeners are going to want to stay tuned. We're going to talk about what you're advising your subscribers, but share with the listeners a bit about what it is that you do.
Well, I really specialize in commodities. I like commodities because you can't print them. And the world that we live in, I think that having some gold or silver and other commodities is very, very important. And what I really do is I look at companies in Canada, the US, and Australia, and look at companies that I like in those markets, and really try and guide investors as to really what I'm doing, and therefore perhaps what they may want to think about doing in terms of allocating capital to commodities.
Well, I'd encourage the listeners to check out Simon's website at BrookvilleCapital.com. In the next segment, we will talk with Simon about what he's advising his subscribers and a bit more on why he thinks commodities are important. That's when RLA Radio returns after these words. I'm Dennis Tubbergen. You're listening to RLA Radio. My guest today, joining me from his offices in the UK, Mr. Simon Popple. If you're just joining us, Simon is the publisher of the Brookville Capital Intelligence Report. You can learn more about his work at BrookvilleCapital.com. And Simon, you said something as we closed the last segment that I thought was great. You can't print commodities, and that's why you like commodities. So let's start with the very basics if we can, and then we'll kind of narrow it down and give our listeners some ideas that will hopefully benefit them. Talk about, for somebody that's not familiar, what are commodities, and can you give us some examples of what they are, and then we'll get into maybe how you can invest in companies that could benefit from a rise in price from commodities.
No, sure. Well, I mean, commodities, you basically use commodities in everyday life, and they're incredibly important. They range anything from the cereal you have in the morning, your cup of coffee, through to hard commodities like gold and silver and cobalt, lithium, iron ore. Basically, as you said at the top of this show, you can't print them, and that's one of the things I like about them, because in certain instances like gold and silver, they've been around for thousands, if not millions, of years, and technology has improved dramatically in terms of being able to find them. For example, you've got things like drones that weren't around several years ago, which means that people can explore on a far more cost-effective basis than they used to be able to do. And so, commodities really are, an interesting area because they're finite in terms of their supply. You do need to find them, and especially with the way the world is sort of developing more towards clean energy, electric vehicles, and things like that. I think it makes sense for people to have some commodities in their portfolio.
Well, Simon, here on the program, we've talked a lot in the past about the importance of owning some gold and silver in your portfolio as an inflation hedge, and we'll go back and explore that. But taking gold and silver out of the conversation just briefly, what are some of the commodities that you really like at this time?
Well, let's sort of break the market down into different segments. I mean, electric vehicles, the way the world is shaping up, you've got things like lithium, cobalt, graphite is quite important for the anode in the batteries, and so I like those commodities. I wouldn't go crazy about them, but I like to have fingers in those pies because if the EV market takes off, then having a lithium or cobalt or nickel or graphite company could do very well. Looking at other sectors, my neighbour, who is probably the greenest person I know, I said to him, "What do you think the greenest form of energy is?" And he actually said uranium, nuclear. And so I think that there's going to be a lot more nuclear power. So, therefore, I think uranium, obviously, you've seen the uranium price recently. I mean, it's going through the roof. But I think uranium is a very interesting market. And then you've got rare earths and various other commodities as well, which they're not called rare for no reason. They're very difficult to find in the kind of commercial quantities that you need to make production viable. So I think that there's having exposure to a broad basket of commodities could be a very attractive way of sort of getting exposure to all the exciting developments going on in the world.
So, Simon, for our listeners maybe that are not familiar with the rare earths and what the industrial application is, could you fill them in? Yeah,
sure. I mean, clean technology is becoming more and more important with climate change and everything like that, and rare earths are increasingly used in different parts of the clean tech world, and so having some clean tech exposure in your portfolio through a tangible commodity, rather than just perhaps investing in clean tech companies, I think is quite important.
So, Simon, if we have a listener that says, okay, this all makes sense to me, I should have some exposure to lithium and cobalt and nickel and graphite and uranium and rare earths, what's the best way for someone to get that exposure in their retirement investments?
Well, a lot depends on their appetite for risk and also reward, because explorers are the sort of the highest risk element of the market. So you could look at companies exploring for those commodities that perhaps found some already, but they want to find more. But that's high risk stuff. But the returns can be fantastic. If you want to be lower down the risk curve, then you probably want to be looking at someone who's developing a resource they've already found. So they're not really looking to find a lot more lithium, cobalt, nickel, whatever it is, but they are more focused on taking what they've got into production. And at the lower end of the scale, which is still considerable risk, you've then got the producers who are producing that commodity, and on the one hand, you've got the risk of sort of mining and production, but you've also got the risk of the commodity price itself, because if the EV market doesn't take off, then what are you going to do with your lithium? And even though a lot of these products have got alternative uses, if you've got a very high-grade manganese or high-grade graphite that is suitable for EV batteries, then using that on a sort of a lower application won't enable you to sort of demand the sort of premium prices that you would get from something like electric vehicles. So, it is a risky market. You mustn't sort of assume that it isn't, because it is. But the returns can be very exciting, and as I say, you can't print commodities. So I think that if you've got a diverse exposure to them, and you've picked the right companies, you can have a lot of fun.
If you're just joining us, we're chatting today with Mr. Simon Popple. He is the publisher of the Brookville Capital Intelligence Report. You can learn more at brookvillecapital.com. So, Simon, take somebody who's listening to this that maybe is aspiring to a stress-free retirement. They're concerned about inflation. They want something to hedge inflation risk. Would you suggest that they look more at the traditional inflation hedges of gold and silver, or should they diversify with some of the other commodities that we've been talking about?
Yeah, well, I mean, stress-free retirement, good luck with that. But I think a lot depends on, how much money they've got and, as I say, their appetite for risk. If they are looking at lower risk, then unfortunately, there's no perfect hedge for inflation. But what they can do is look at historically what has happened. By all means, get in touch with me, and I can send you some information on what's happened historically to various asset classes. And I think you just hope the history broadly repeats itself. Me personally, I like to have a diverse exposure. I don't want it to be purely to gold or silver or other commodities which are purely for hedging inflation. I like to have exposure to other areas as well. So, commodities for uranium and electric vehicles and things like that. So I think that people, if they want a bit more risk, then have a few more commodities. But if they really don't want to have any risk at all, then or not any risk at all, but if they want to be at the lower end of the risk curve, then perhaps having some physical gold, physical silver in storage is perhaps more what they're interested in. But they really need to discuss things with their financial advisor to work out what is best for them.
So, Simon, I'd love your take moving ahead on gold versus silver, and which of those metals you think has more upside potential. We've often talked here on the program of the level of industrial demand for silver really outweighs the production. There's on both gold and silver, more investors in the futures markets are standing for delivery of those metals, and yet the price has been suppressed. So just two questions in the time we have left. Moving ahead, do you like gold or silver better, and why have those prices seemingly not kept up with inflation like, say, oil has, in your view?
Well, I think the answer is I like both, but I think gold is I feel more stable. Silver is more volatile. If you look at the prices of gold and silver, gold is fairly close to previous highs, whereas silver is a long way off previous highs. So I think that silver has probably got more way to go, but I think it makes sense to have a bit of both. And if you want to have a silver coin is probably worth I'm guessing sort of $30-40, which is pretty useful. If you ever need to use that, that's fantastic. But you don't want to be walking around with a gold coin in your pocket if you want to go shopping, and it's worth $1,000, because what are you going to do with $1,000 in a supermarket? But looking at them from an investment perspective, I think that I like silver because it's got more uses, but it is incredibly volatile. And if you look at what happens with the silver price, it's suitable for some investors, but if you're retired and you look at it on a daily basis, it could be quite traumatic.
Well, my guest today has been Mr. Simon Popple. He is the publisher of the Brookville Capital Intelligence Report. You can learn more at brookvillecapital.com. I'd encourage you to do that. And Simon, always a pleasure to catch up with you and have you on the program, and love to have you back down the road. Thank you for joining us today.
Really enjoyed it. Thank you very much.
We will return after these words.
I am Dennis Tubbergen, and you're listening to the Retirement Lifestyle Advocates radio program. Thanks again to Mr. Simon Popple for joining me on today's program. This past week, I was reading an article authored by past guest here on the program, Mr. Jeffrey Tucker. He writes for the Brownstone Institute, and it was an extremely well-done article, and it addresses the root cause behind some of the shortages that we are now seeing, and I wanted to share it with you. We are certainly in a different world, and as I talked about in the first segment, if you use traditional retirement planning strategies to attempt to achieve your retirement goals, it's my belief that you may fail, and I'd like to offer you a resource to give you a different perspective. The book is Retirement Roadmap. The subtitle is How Many Aspiring Retirees Can Use the Revenue Sourcing Process to Achieve a Secure Tax-Free Retirement in Today's Economy. I'd love to send you a complimentary copy of the book. All you need to do to request the book, and I'll send you some bonus information as well, is visit roadmaptoretirementbook.com. The website again is roadmaptoretirementbook.com, and I'll be very glad to send you a complimentary copy. Back to Mr. Tucker's article. It was titled, The Rationing is Already Here. And he starts the article by relating an experience that he had in a liquor store of all places. He asked the clerk, who happened to also be the owner of the store, for pomegranate liqueur. The owner's response was, I don't have anything, I can't get anything, I can't even get bourbon. Everything is running out. The store owner went on to explain that distributors come to visit him, but always with bad news. They don't have anything to sell. So why are they visiting the store? Well, it's their job. They're making the rounds, but they don't have product to sell. So Jeffrey asked the question, how long before we face government-imposed rationing? And he points out that it's already here. Pennsylvania and Virginia have state-run liquor stores. These states have imposed buying limits on bottled liquors, 2 bottles a day. If you're having a big party, plan in advance, or lower your expectations, which has become a commonly used phrase today. Well, Jeffrey asked the liquor store owner what he saw as the problem. And the liquor store owner, interestingly, said it's about clogging at the ports. It was his opinion that the product is there, but no one can get the product. And it's not just the finished product. He said it's the bottles that the breweries and distilleries need just to package up their product and sell it. So the product just sits there in barrels, waiting and waiting. And meanwhile, everybody is losing money. Now, a lot of these bottles, he related, come from Mexico or overseas, which accounts for even why products made in America are still sitting on the shelves of manufacturers. The supply constraints are pushing up prices alongside rising demand stemming from the floods of money pumped out by the Fed, as Mr. Tucker says, to back outrageous spending by Congress. We can probably all agree with that. The liquor store owner also said there's a labor problem. We talked about this in the first segment of today's program. The owner of the store was working the cash register, and he was the only person in the store, and he has been working from 9 a.m. to 10 p.m. every day. Tucker says, remember how business owners are supposed to get rich and hire other people to do their work? Well, it's not exactly working out that way. He has a now hiring sign on his window, and he hires people, but he can't keep them. He says they walk out suddenly and don't come back. There are no new ones to hire. If someone does stop by, they make outrageous salary demands, and then when he thinks about hiring them, he's found that they fail the background checks that are required in his industry. Mr. Tucker asked the business owner why he thought this was. Why is there a labor shortage? And the business owner said that the lockdowns just showed millions of people they can get by without working. The government dumped money into their bank accounts. Young people moved home or rented 3-bedroom apartments. They stuck 6 people in there and shared the rent and discovered they can live cheaply. And they have even more money than they've ever had when they were working. And that was his analysis. So where are we at presently? Well, Mr. Tucker, and I happen to agree with him, said that we are really facing the perfect storm, and it's hitting from every direction. Inflationary pressure is driving up prices of basically everything. Ports are clogged. Laborers have dropped out, as I related in the first segment. 4.3 million workers quit their jobs in August alone. The flow of goods is slowing more by the day, and consumers are starting to notice. So we're living in a world that is very different from the world we lived in just a couple years ago. And what's the solution? Well, there was an op-ed, interestingly, in the Washington Post, and it was written by one of the Post's regular contributors, Micheline Maynard, who said, just get used to it. We've got to lower our expectations like people did in the 70s when they needed to have gasoline, like they did in the 40s when food was rationed, and in the 20s when housing was rationed. So expect more of the same. Well, I think for many of us, this is a disturbing world, and for those of you that are planning for retirement, it's even more alarming. That's why I'd like to offer you an additional resource. If you're just joining me, the Retirement Roadmap book is being made available absolutely free of charge for the rest of October. If you'd like to get a copy of the book, just visit roadmaptoretirementbook.com. That's roadmaptoretirementbook.com, and I'll be very glad to get you a complimentary copy out along with some bonus material. Again, the website, roadmaptoretirementbook.com, and if you'd like to go back and listen to any of the podcasts, any of our radio programs, you can download the RLA app by visiting the App Store and searching for Your RLA. That's YOUR-RLA. Type it in all as one word. You can download the app and get access to all of our podcasts and other free resources as well. That's the program for this week. Hope you got something you can use. I'll be back again next week.